Welcome back to the Explainer. Okay, listen, let's dive straight into this one because we are currently looking at a market anomaly that is absolutely dominating the financial headlines right now. We are talking about Applied Optoelectronics, ticker symbol AAOI. Recently, this stock has completely defied gravity. I mean, it literally rocketed up into the $200 range, closing recent trading sessions right around $202.89. We are seeing numbers that are making retail investors and institutional funds alike just stop dead in their tracks. It is a massive stock market event, and today we really need to figure out if this is a genuine fundamental shift in the company's value or if it's just an overvalued hype train that is waiting to derail and leave a lot of people holding the bag.
That is precisely the right question to ask. The recent NASDAQ market activity, coupled with their latest SEC filings, points to a massive reassessment of the company's valuation by the broader market. Now, this movement is heavily tied to the artificial intelligence infrastructure boom. But to understand if this massive $200 valuation actually holds weight, we have to strip away the hype. We have to look strictly at the underlying financial and operational data. We need to see what the numbers actually prove.
Wow, I mean, this is crazy. 411.04%, a year-to-date share price return of over 400%. And look, if you dive into the Simply Wall Street data, over just a 3-month period, the stock is up more than 7 times. 7 times. My jaw is literally on the floor here. For our viewers who are just tuning in and looking at their own standard portfolios, this kind of explosive vertical growth is incredibly rare. What on earth is driving a 411% surge in such a ridiculously short window?
Well, if you look at the data here, it shows that this 411.04% year-to-date surge is absolutely not occurring in a vacuum. It is being directly driven by the broader AI infrastructure theme. According to the tracking data, AAOI is actually moving alongside 47 other specific AI infrastructure stocks. What's happening is that the market is pricing in exponential future growth based on some very specific capacity expansions in recent strategic partnerships. And that is exactly what we are going to analyze systematically today.
Perfect. And to figure this out, we have a very clear roadmap for today's explainer. First, we'll cover the AAOI stock surge. Second, we're doing a financial fundamentals deep dive. Third, we'll look at their AI and broadband moats. And finally, number 4, 3 future investment scenarios. Let's get right into it. So, starting with part 1, the AAOI stock surge, and really raising the issue of what's going on here. All right, before we get lost in the weeds of SEC filings and these massive percentages, I have a very, very basic question for you. I see the word optoelectronics in the name, but what does this company actually do? That's way too complicated for the average person. Could you give us a simple analogy? Because right now, to a whole lot of people out there, AAOI are just 4 letters on a ticker tape that are making people incredibly rich.
Absolutely. Let me break this down for you with a very basic analogy. They essentially build the high-speed optical plumbing that lets AI data centers and internet providers pump data at lightning speed. Think of it like this. When an artificial intelligence system processes massive amounts of data, that data has to physically travel between servers. It doesn't just float in the air. AAOI manufactures the 800G and 1.6 terabit transceivers. These are essentially the ultra-wide, high-tech pipes that allow that data to flow across the data center without creating bottlenecks. Now, on the other side of their business, for broadband companies, they build the physical amplifiers that actually push high-speed internet through the cables directly to your home.
Okay, so what you just said basically means they are the guys selling the pickaxes and the plumbing during this massive AI gold rush. That makes perfect sense. But why the sudden explosion right now? Why are we seeing this massive surge today?
The driving forces behind this timing are clearly mapped out in the data. There are really 3 real, tangible causes hidden behind the recent news headlines. First, we have hyperscale AI data center demand. In the first quarter, AAOI actually completed their very first volume shipment of 800G products to a massive hyperscale customer. Second, telecom broadband upgrades. They just recently secured a massive deal to support a DOCSIS 4.0 network upgrade. And third, massive capacity expansion expectations. If you look at market notes from firms like Rosenblatt, they highlight an expectation that optical component manufacturing must expand exponentially just to keep up with AI. AAOI is aggressively positioning itself to capture that exact supply gap.
Which brings us nicely to part 2, a deep dive into their financial fundamentals. Let's look at the numbers. Okay, so let's look right under the hood at the actual SEC filings. Are they actually making real money from all this optical plumbing, or is this just a pipe dream built on hype? I see those revenue bars going in the right direction on the screen. Walk me through these actual numbers.
It's proven by the numbers right here in their filings. In the first quarter of 2025, their GAAP revenue was $99.9 million. Fast forward to the first quarter of 2026, and that GAAP revenue reached $151.1 million. That is a highly impressive 51.4% year-over-year revenue growth. Furthermore, this actually marks their fourth consecutive quarter of record revenue. Dr. Thompson Lin, the company's CEO, explicitly noted in the filings that this was driven by broad-based demand in both their data center and their Cat-V broadband businesses. But it was heavily propelled by those new volume shipments of 800G products going out to hyperscale customers.
Okay, so they are bringing in a literal mountain of cash. $151 million is nothing to sneeze at. But wait, looking at this table, something isn't adding up here.
You are observing the profitability metrics, which definitely show a stark contrast to that top-line revenue growth. It's a very important distinction. Despite the record $151.1 million in revenue we just talked about, the company actually reported a GAAP net loss of $14.3 million for the quarter. That translates to a negative $0.19 per basic share. Additionally, if you look at their efficiency, their GAAP gross margin actually contracted slightly. It dropped down to 29.1%, which is down from the 30.6% they reported in the first quarter of the previous year.
Wait a minute, hold on a second. What does that have to do with our stock accounts? Seriously? They are making record money, $151 million in revenue. So why is the market going completely wild and pushing the stock to $200 when they are actually running a $14.3 million deficit? Their gross margins are even down. Are retail investors just throwing their hard-earned money into a burning furnace here?
It's a valid concern, but the market is actively discounting the current deficit because it is evaluating the specific cause of those expenses. It's not just a black hole. According to the SEC filings, AAOI holds $449.3 million in cash, cash equivalents, and restricted cash as of March 31, 2026. Keep in mind, that is up significantly from $216 million just at the end of 2025. The data clearly shows that this deficit is absolutely not stemming from a failure to sell their products. Rather, it is being entirely driven by aggressive, capital-intensive scale-up operations designed to meet massive future demand.
Okay, so if it's not a failure to sell, where exactly is all this cash going? If they have nearly $500 million in cash but are running a loss, what are they buying?
It is being funneled directly into physical infrastructure. The company is currently underway with a massive expansion of its manufacturing facility located in Sugar Land, Texas. The financial data shows they initially programmed about $150 million in capital expenditures for this, but they later doubled that commitment to $300 million by the end of 2027. They have nearly doubled their entire Houston area footprint, creating a sprawling 210,000 square foot manufacturing warehouse. The strategic objective here, based on the filings, is to strengthen domestic U.S. manufacturing, to rapidly scale their advanced optical transceiver production, and to ultimately become the premier high-volume U.S. producer of AI-focused data center optics. The market is pricing in the massive future output of this Texas facility, not just the construction costs of today.
Which leads us perfectly into part 3, the industry environment and their economic moat. So what you just said basically means they are taking a planned short-term hit to build a massive fortress in Texas so they can completely dominate the U.S. market later on. I get that. But what is their irreplaceable weapon inside that fortress? What makes this massive $300 million spending spree actually worthwhile in the long run? Let's start with the AI data centers. Literally everyone is talking about AI. What is AAOI's specific advantage here?
Their primary economic moat is their highly specialized, high-volume manufacturing capability for advanced optical transceivers. Let's look at the numbers. The Q1 data explicitly states they exited the quarter with a total manufacturing capacity of nearly 100,000 units of 800G transceivers per month. That capacity is spread across their US and Taiwan locations. Furthermore, they are already seeing very strong customer engagement around their next-generation 1.6 terabit products. In an industry where the pure speed and volume of data transfer are the ultimate physical bottlenecks for AI development, the ability to actually physically manufacture 100,000 of these highly complex, high-capacity units every single month is a massive, tangible barrier to entry for any competitors trying to enter the space.
Okay, 100,000 units a month sounds like a lot to a regular person. But let's be real here. Is it really enough to justify a stock price shooting up 400%?
The mathematical justification for that actually lies in the broader industry forecasts. According to a highly cited market note from Rosenblatt, optical component manufacturers will need to expand their production capacities by approximately 12 times through the year 2030. 12 times. And that is just to meet the rapid projected demands growth from AI infrastructures. Rosenblatt also noted in their data that last year, the supply of indium phosphide-based datacom components actually lagged behind demands by 50%. Therefore, AAOI isn't just building a factory into a stable, stagnant market. They're quite literally racing to fill a massive 50% supply deficit in an industry that mathematically needs to grow 12-fold over the next 6 years.
Wow. Okay, and this brilliantly illustrates the demand side of the equation. That is a massive gap to fill. But AI isn't their only game, right? I see Mediacom up on this slide. What's happening in the broadband sector? Because that sounds totally different.
Correct. Shifting over to their CAT TV or cable television broadband moat, we need to look at their recent agreement with Mediacom. On May 12th, it was officially announced that AAOI is the primary vendor for Mediacom's DOCSIS 4.0 network upgrade. Now, this is a major project designed to upgrade 1 million homes by the end of 2026. AAOI is specifically supplying their Quantum 18 1.8 GHz amplifiers and line extenders for this project. This is crucial because it validates their legacy broadband business. It shows that as these large traditional cable operators are forced to upgrade their aging coaxial networks to deliver fiber-like internet speeds to consumers, AAOI is the chosen, trusted supplier actually providing the physical hardware to make it happen.
Okay, I hear you. They have the AI data center plumbing lockdown. They have these massive Mediacom broadband deals. It sounds absolutely perfect. But listen, I'm the viewer's spokesperson here, and my alarm bells are ringing loud and clear. There is always a catch on Wall Street. Always. Give me the fatal weaknesses. What could go wrong here?
You are entirely right to ask, and the risks are clearly documented in both the Simply Wall Street analysis and the company's own forward-looking SEC risk disclosures. First, they have a heavy reliance on a few hyperscale customers. A substantial portion of their AI data center revenue is highly concentrated. If just one major tech giant decides to change suppliers or delay an order, AAOI's revenue will plummet. Second, the capital-intensive nature of their expansion. That $300 million Sugar Land project requires immense, ongoing cash flow to maintain. Third, and arguably most critical to the retail investors watching this, is ongoing stock dilution. To fund these massive factory expansions despite currently running a net loss, the company has historically utilized equity offerings. When they issue new shares to raise capital, it fundamentally dilutes the value of all existing shares held by current investors.
Which is exactly why we need part 4, 3 survival scenarios in the forecast. Okay, to summarize all of this, if their big tech customers walk away, or if they just relentlessly dilute retail shares to pay for that massive Texas factory, investors could get completely crushed. The stakes are incredibly high right now. I demand to know the actual forecast for the stock moving forward. Why is there a giant $78 on the screen when we literally just talked about the stock trading at $200?
This is where the numbers get very sobering. According to the strict quantitative analysis provided by Simply Wall Street, the estimated fair value of the stock is exactly $78. At a current trading price of roughly $202, the stock is calculated to be 159.4% overvalued based purely on fundamental, discounted cash flow models. The narrative that is currently pushing the stock to $200 leans heavily on rapid revenue acceleration, future margin lift, and premium future profit multiples tied exclusively to the AI data traffic boom. The $78 figure on your screen represents what the company is actually mathematically worth today, based on current, tangible financials. This highlights a massive, massive gap between the future narrative valuation and the current market pricing.
Yeah, that is a terrifying gap for anyone thinking about buying at the absolute top of this run. So how does this actually play out in the real world? Break down the survival scenarios for us.
Based strictly on the data, we can map out 3 distinct paths, each triggered by specific real-world conditions. First, we have the bull case, the optimistic scenario. The trigger here is that the Rosenblatt forecast of a 12x capacity expansion materializes flawlessly, and AOI successfully scales its Sugar Land facility without any severe cost overruns. If that hyperscale demand holds steady and they reach their projected path to nearly $1 billion in revenue with expanded margins, then the market's current premium is fundamentally justified, and that $200 price tag actually becomes the new floor. Second is the base case, or neutral scenario. The trigger here is steady but moderate growth. They execute the Medicom upgrades, and they maintain their 100,000-unit 800G shipments, but that heavy $300 million capex forces ongoing shareholder dilution just to cover the quarterly deficits. In this scenario, the stock likely trades sideways for a long time or slowly deflates as the actual financial performance struggles to catch up to the massive AI hype. Third is the bear case. The trigger here is the actual materialization of those risks we discussed. If customer concentration backfires, meaning a major hyperscale client pulls a massive order, or if the U.S. manufacturing ramp faces significant construction delays, the entire growth narrative collapses. In that worst-case scenario, the stock would likely revert aggressively downward, crashing back toward that $78 fundamental fair value estimate.
In the short run, the market is a voting machine, but in the long run, it is a weighing machine. That iconic Benjamin Graham quote perfectly encapsulates exactly what we are looking at with applied optoelectronics today. Right now, the market is aggressively voting on the massive hype of AI data centers, the promise of 12x expansion, and these insane 400% returns. But eventually, the market will act as a weighing machine. It will weigh those heavy $300 million capital expenditures, the dangerous customer concentration, and that $14.3 million net loss straight against that $78 fair value reality. It is a fascinating, high-wire act of optical plumbing in pure stock market mania. Thank you so much for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our work. So, what do you think? Is AAOI the absolute future of AI infrastructure, or is it just a hype bubble waiting to pop? Let us know your thoughts in the comments below, and we'll see you next time.